Good afternoon. Today we're going to be doing liquidations. I'm Ms. Aronson. That is my email address. So when you guys are busy preparing for your exam, if you have a small question, you're welcome to email me. And that's my office number, and you should enter at entrance 2. Okay. And then if you guys want to do the beer conversion, you should have received an email. For those of you that want to convert, just a reminder that you need to have not only passed 2 and 8, but all your first year subjects in 1 year. Okay? And then, so basically, passing 2 and 8 alone does not give you entrance to the conversion exam. If you have any questions, please email Mrs. Smith. Okay. The handout session is tomorrow and Friday at 3124, that big lecture venue. If you can't make those times, then you can go to 2120 on those dates, but this is on Sunday. Okay. Today we're going to do 6.1, which is a scene, so you have the solution and all the slides for liquidations. Tomorrow we'll be doing question 6.2, you don't have the solution, okay? And then on Friday we're doing 6.6 and 6.5. The focus will be on 6.6, which is a very important question. And then I'll just show you what's different with 6.5. And we also do not have the solution. And then next week we'll be doing revision. Okay, and the Friday is the question class. If you don't have any questions, you don't have to come to class. Quick, some students have asked about, when you do your journal entries, they've asked, should you specify in brackets if it's an SFP or if it's an SEI, when you do your journals. So we're not too concerned about it. The only times that we really are concerned is when the descriptions are the same. So for example, debit deferred tax, credit deferred tax. You need to say, is it SEI or is it SFP? Because then you won't get the mark because you're not saying which side it should be. Okay? Right. Okay, so let's get started. So at the end of this chapter, you should be able to record a liquidation in the accounting records. The focus is on general journal entries and the T accounts. Okay? So it's not so much the focus on the theory or on the statement of or the statement of financial position or setting up statements. The focus will be on setting up journal entries and setting up the T accounts. Okay? It's not to say that you can't be tested on the others, but the focus is on this. So what is the liquidation? So basically the company terminates, it's no more. So there's a process where all the assets of the company they're being sold, so you receive money for them and they're being realized. And then you use that money to settle the cost of liquidation and you pay your creditors. Okay, and you'll see now that there's an order in which the creditors are paid. And then after you've settled your creditors, you'll see that there will be a surplus or deficit in the liquidation account, which you will attribute to your preference and ordinary shareholders. And we'll see now that there are also rules with how you attribute that surplus or deficit. There are two methods of liquidation. It's either compulsory, so the company can no longer pay its creditors, so the court forces them to liquidate, or the shareholders just decide this is not working anymore, and they do a special resolution and they apply to have the company liquidated. Okay, so it's voluntary and compulsory. There are 7 steps. Like when you just have 7 steps to the liquidation process. If you follow these steps, you sort it. Because it's literally, that's all it needs. Follow the steps and that's the whole liquidation process. Okay. So the first step was we transfer all our assets to the liquidation account, and we'll have a look at the journal entries now in terms of how that is done. Then we transfer all our reserves on the statement of financial position to the liquidation account. The reserves would be like the accumulated loss or the retained earnings. Okay. Then we transfer all our liabilities to the liquidation account. Okay? So you're basically transferring everything that's on your statement of financial position to the liquidation account, and all that is left, or all that will be left on the statement of financial position will be share capital. Okay. Then, so then step 4 is you receive the proceeds on sale of assets, so you sell your assets and you receive physical money. Step 5 would be you take that money that you received and you'll receive it in your trust account. Okay, we'll have a look at the journals now. You take the money that you've received and you pay your liquidation costs. Okay? And then you will pay your creditors, and we'll see the order in which you pay your creditors. And then step 6, you will be left with the surplus. So once you've transferred everything to the liquidation account, and once you've received and paid money out of your trust account, the contra here will also be the liquidation account. Okay? So everything here would have gone to the liquidation account, and then your balancing figure will be your surplus or your deficit, which you'll allocate to your shareholders. Okay? We will look at that now in more detail. And then once you've distributed the surplus or the deficit from the liquidation account to your ordinary or preference shareholders, then you'll have a balancing figure for each of these, which you will settle. And once you settle, then once you've paid your shareholders, their balance would be 0. Okay. It will become more clear now when we do it with journal entries. Okay. So these are the 3 important accounts that you need to know for this section. So you need 3 T accounts. These are the 3 T accounts you need. It's the liquidation account, which is like a realization account. So you know when you sell PPE and you have profit or loss on sale of PPE and you have that realization account, it's the same thing here. Okay, so all the proceeds, all the carrying amounts from the disposal of the liquidation proceeds go to the liquidation account. And that's where you'll get your deficit or your surplus. Same as the realization account for sale of PPE. Then you have your trust bank account, so any money that comes in from the sale of assets or any money that goes out from paying your creditors or your liquidation costs go to this bank account, trust bank account. And then we have a T account for our shareholders and preferences, and that's the last balance we have, and that's the balance we're basically trying to find out, because these are they get paid last. Okay. So the first step 1, we said we're going to allocate all of our assets to the liquidation account. So you know an asset is a debit balance. So to get rid of a debit balance, we need to credit it, right? So we're taking it off the SFP, we're crediting it, and our contra is the liquidation account. Step 2, we said we're going to transfer all of our reserves to the liquidation account. So an accumulated loss is a debit balance. If I want to remove a debit balance, what do I need to do to it? I need to credit it. So I credit accumulated loss and I debit liquidation. It's always the contra. Likewise with retained earnings, it's a credit balance, so to get rid of it, or to remove it from our SFP, I need to debit it. And the contra will be liquidation. You obviously can't have both, it's either or. Step 3, you transfer your liabilities. Liabilities is a credit balance. To get rid of it, to take it off the SFP, I need to debit it. Debit liabilities, contra is liquidation account. So now you've transferred everything that was on your SFP, you've transferred it to the liquidation account, okay? And this is what it would look like, okay? So basically all that you have left on your SFP now is share capital. You haven't yet transferred it to, it doesn't go to the liquidation account. Step 4 is now proceeds. So when you sell your assets, any money that you receive from that sale of the assets goes to your trust account, which is the bank account. So the money goes there and your contra is the liquidation account. Contra is always liquidation. Okay, so that's for the sale of assets, both secured asset and unsecured assets. Okay, you know secured asset is like a bond. The house is held as security for the mortgage bond. Okay. Then, so basically, once you've transferred all of your assets, your liabilities and your reserves, and you've received money for the sale of assets, this balance over here will be used to pay for your liquidation costs and to pay your creditors. Okay. So step 5, we're going to pay our liquidation costs. So money is going out of the bank account, so we credit our trust account. Okay. And the contra is the liquidation account. Okay, so that's the first thing we pay after we sold our assets. Examples of this, not in your slides, I just added it. Examples, it's like administration costs, the liquidation process. The cost of the liquidator, any bank charges, advertising for the whole liquidation process, cost of preparing the financials for the affairs of the company, cost of realization of the asset, basically administrating the whole liquidation process. You know, your admin fees for the whole process. So that is, and your sheriff costs, who has to now hold the auction to sell the assets, etc. So that's your section, your step 5.1 cost. That's the first thing you pay. The second thing you pay, so this is step 5.2, is, so the second thing you pay, so like I said earlier, if you have a secured asset, so for example, I have a house and I have a bond that is linked to that house. That house is held as security for that bond. Okay? So that house, bond is secured by the asset, which is the house. Okay? So when I sell the house, any proceeds from the house will first be used to settle the bond. So if I sell the house for 120,000, and let's say the bond is 100,000, great, I pay the bond 100,000. But let's say the proceeds are not enough. Okay? So I sell the house for 80,000, right? But the bond is 100. So the funds are insufficient to cover the bond. So there's a 20,000 rand, for example, that has not yet been paid. That 20,000 debt becomes a concurrent creditor, which we'll deal with in step 5.4. Okay? And we're not going to treat that asset as a preferential or as a special, the balance, we're not going to treat it as a special creditor. It's going to be treated like any other creditor. Okay. So let's say after I sold the house, I sell the car and I get 30,000. I'm not going to use the 30,000 of the car to first pay the bond. Okay? Because remember that the balance that was left on the bond, that 20,000, is a normal creditor. Does that make sense? Okay. So the 20,000 goes into the pool of all of the other creditors that are also in. So proceeds from the sale of other assets, i.e. the car, so I said it was a car, or equipment, whatever, not used specifically for the rest of the debt that was secured. Step 5.3, we have preferential creditors. So these are creditors in terms of the act. So in terms of an act, like money that's owed to employees, money that's owed to SARS, or any other preferential creditors. Okay? So here's an example from your textbook. Any money that's due to SARS in terms of the Income Tax Act, or in terms of the Employees Act or VAT Act, anything in terms of the Act would be a preferential creditor. You'll settle them third. Okay, so we've already settled liquidation costs, 5.1. Any secured assets, 5.2. Okay, and then 5.3 will be the preferential creditors. Right, and if there's not enough money to pay them, we'll settle it pro rata. Okay, to extent of their balances. Okay. Then step 5.4, any other money that you have left will be used to pay all the other creditors. Basically the creditors that are not secured creditors. So they're not secured creditors, they're not preferential, any other creditors will be step 5.4. So that 20,000 rand that was unsettled from the bond after we sold the house is going to form part of a concurrent creditor. Okay. So if we don't have enough money, we're going to settle it. Okay, so if we do have enough money, we'll pay all the creditors, the balancing creditors, we'll pay them what's due to them. But if we don't have enough money in our trust bank account, we'll settle the concurrent creditors pro rata. So basically in terms of their balances. Okay, so the one has a balance of 10, 30 and 50. So that's 80. So one will get 10, the portion of 10 over 80, 30 over 80, 50 over 80. Okay, that's the portion of the remaining funds that creditors will get, pro rata. Okay, and then just a note, if only partly preferential, the rest is concurrent. Same with the mortgage bond. Whatever's unsettled after you sold the house comes here. Whatever's not preferential comes there. Okay, comes to 5.4. And if a creditor accepts the offer from the liquidator, cannot receive further funds later. Okay, so now that we've done all of the steps, we've transferred everything on our SFP to the liquidation account, we've received proceeds on sale, we've settled liquidation costs, we've settled all the creditors, then we have a deficit or surplus on liquidation. This will be your balancing figure. So you literally balance your T account after you've gone through steps 1 to 5. So once you have your surplus or liquidation, once you do surplus or your deficit, so before you calculate your surplus or deficit, you'll first see, do you have enough money in your trust account to pay any preference dividends? Okay. So you've gone through this whole process before you calculate the surplus or deficit in your liquidation account, right? You go to your trust account, see if you have enough money, not your liquidation account, your trust account, because that's where all the funds are at after you've paid everyone. Do you have enough money to pay preference dividends? If you do have enough money, you'll pay the preference dividends, and then if there's anything left, so you'll pay the preference dividends, and then you'll calculate your surplus or your deficit in your liquidation account. Okay. So it's cumulative unless the MOI states otherwise, and the MOI, the dividend would need to have been declared before the liquidation. That's the rule. And the MOI will determine if those preference shareholders have the preferential right, even if it's not declared. Okay. But the point is, before you calculate your surplus or deficit in the liquidation account, you check if your trust account has funds to pay a preference dividend, you accrue for the preference dividend, and then you pay it. And then you calculate the deficit or surplus in your liquidation account. Okay. So when you accrue for the preference dividend, let's say, okay, I've looked at my trust account, I have enough money, even if it's only a portion of what they're supposed to get. You see that there's enough money to pay preference dividends, you accrue for it. So you say debit liquidation account, credit preference share capital. It's as if I'm increasing the amount that I owe them. So I credit the preference share capital, and then I pay them. Okay? So I decrease what's due to them, and the money goes out of my trust account. Okay? Does that make sense? So now that I've paid my preference dividends, if there were any, and if I had money for it, then I calculate my deficit and surplus in the liquidation account. Okay? And can you see why we first accrue for it? Because the preference dividends impacts my liquidation account. So I first have to do that before I do my surplus and deficit. Yes.
Would that only be with accumulated preference share dividends, or is it just whatever is left?
Now that I've done all my steps, I'm on step 7 now. I'm on step 6 now, sorry. I go to my liquidation account because everything is obviously gone there, and I'll calculate what is my surplus or my deficit. You literally balance your T account, your liquidation T account. So if there's a surplus, it will be on the debit side. That will tell you that it's a surplus. The surplus will only be attributed to or distributed to ordinary shareholders. If you think about if it was a normal circumstance where the business was making profits, ordinary shareholders only share in profits, right? The preference shareholders don't share in profits. So if there's a surplus on liquidation, it would only go to ordinary shareholders. Okay. But if there's a deficit, then you would share the deficit between the ordinary and preference shareholders. But there's a rule here. So if we tell you that the preference shareholders do not have a preferential right to capital, okay, then if they don't have a right to preferential right to capital, then they will share in the deficit. Okay? Which makes sense. You don't have a right to preferential capital, so you will share in the deficit. So, and the deficit will then be allocated proportionally on the balances of the ordinary and preference shareholders. Okay? Does that make sense? But if the preference shareholders do have a preferential right to the capital, then it's almost like they're protected from the deficit. They have a preferential right. They're protected from the deficit, but obviously we sort of first allocate the deficit to shareholders in as far as we can, and if there's deficit left over, we'll allocate it to preference shareholders. Okay. So we'll allocate it to shareholders in as far as we can. So let's say the deficit was 60. My shareholders, ordinary shareholders balance is 50. I can only allocate 50,000 of the deficit. The other 10 will then go to the preference shareholders. Okay. Does that make sense? Okay, so just remember surplus, all to ordinary shareholders. Deficit, what is the preferential right? Do they have a right? Yes. That means I will not allocate, or not, I won't allocate the deficit, but I'll first allocate it to ordinary in as far as I can. And if they do have a preferential, if they don't have a preferential right, I'll allocate it equally to preference and ordinary shareholders. Pro rata. Okay, so this is what once you transfer everything here, your liquidation account should balance now. Because remember, the surplus or the deficit was the balancing figure. So your liquidation account should balance. Okay? And remember, once you've calculated your surplus or deficit, you will allocate it to your ordinary preference shareholders only if it was a surplus, or we would have reduced ordinary and preference if it was a deficit, depending on the preferential right. Okay. I just want you guys to note here, can you see that this over here is everything in my SFP besides share capital? You guys see that? And this over here is everything in my trust account. Okay? There's my proceeds, that's what I've paid, that's what I've paid, that's what I've... Okay, no, that's what I've paid and that's what I've paid. So basically over here, this difference between that is the portion of the net proceeds over share capital. You guys see that? So which means, obviously, if there's that which will be the deficit or the surplus, so if you allocate that to shareholders, then what's left in your trust account will be exactly equal to the balance in the share capital accounts. So basically, the money that's left in your trust account will now be equivalent to the ordinary and preference shareholder balances, because you've adjusted their balances for the deficit or surplus. Does that make sense? Does it make sense? Okay. So that's the whole point. SFP, trust account, the difference is the surplus or the deficit. If you allocate it to share capital, which is basically that, you will amend in the balance, and then what's left in your trust account will be exactly equal to your share capital and preference capital balance. If it's not, you did something wrong. Okay. So it will work out. So then you will see the money in your trust account will be exactly equal to the balances in it, because you adjusted for the deficit and surplus. Okay. So then now that my step 7 is to pay, so whatever money is left in my trust account, I credit my trust account because I'm making a payment, and I'm debiting share capital. I'm basically reducing what I owe them. Okay. And then, so that is step 7. So after I've adjusted for the surplus or deficit in the share capital account, what's left in the trust account will pay this balance. And then your share capital balance will now be 0. So can you see that the whole point of going through the liquidation process was to find out what the share capital balance was, and then use the remaining funds to settle them loss. Okay. So now, let's look at a practical example. Our liabilities and our reserves. And then we see that we have, so wait, here's my assets. All of my assets. Remember step 1 was to distribute, to transfer all your assets to the liquidation account. Remember step 2 was to transfer all your reserves to the liquidation account, and step 3 was to transfer all of your liabilities to the liquidation account, and then you leave everything over besides share capital. You do not transfer that to the liquidation account. And let's see what else we have. They said the shareholders decided to liquidate the company, and the liquidation costs amounted to 15,000. We know that that is step 5.1. We first pay our liquidation costs. And then they say that we sold all the assets for 840,000. So that was step 4. Okay. When you receive any proceeds on sale, that will be step 4. And we're going to go through the journals now to see how the process works. There was no outstanding preference dividend, so you don't have to check for that. And then the preference shareholders do not have a preference right. So if there is a deficit, they will share in the deficit. Okay, because they do not have a preferential right, so they're not protected. Okay, so they will, if there is a deficit, they'll share in the deficit, pro rata. If they did have a preferential right, then we'll allocate it first to shareholders and as far as we can, balance to preference shareholders. And if there's a surplus, only ordinary shareholders get the surplus. Okay. Show the journal entries which would be necessary to complete the liquidation and then prepare the general ledger accounts. Remember I said these are the four important T accounts that you need to know. Okay, so let's do the step process. So step 1 is to transfer all of our assets. Okay. Assets is a debit balance, right? So to take it off the SFP, I need to credit it. So I'm going to credit property, plant and equipment with the 500,000. Taking it off the SFP, sorry. Credit inventory, taking it off the SFP, 100,000. It's a debit balance, so to get rid of it, I need to credit it, right? And I need to debit which account? Liquidation, always, with 600,000. Step 2. Step 2 is transfer all reserves. I think your steps might be a bit different in the textbook, but it doesn't really matter as long as you do step 1, 2 and 3 together. Step 2 is to transfer all the reserves. So do we have an accumulated loss or retained earnings? It's a loss. Okay, so a loss is a debit balance. To take off a debit balance, what do I need to do? I need to credit it. So let's credit accumulated loss with 220 and debit liquidation account. Obviously, if it was retained earnings, it would be the other way around. Step 3, transfer all liabilities. Okay, that was my assets, my reserves. Now I need to transfer my liabilities. The liability is a credit balance. To get rid of a credit balance, I need to debit the loan. And it was 620. Okay, so 620 there and credit liquidation account. Okay, so I've transferred all my assets, I've transferred all my reserves, transferred all my assets, I've transferred all my reserves, and I've transferred my liabilities. I've done steps 1, 2 and 3. We're happy. Okay. Step 4 we said was if we receive any proceeds from the sale of our assets, we will account for that. And they said here that the assets were sold for 840,000 Rand cash. So that's money that's physically coming into our bank account. So we'll say debit trust account with 840 and credit liquidation account. Should we use a different color? Let's use black now. $840. Okay, so that was step 4. Any proceeds that you receive on the sale of any assets. Your bank account's increasing and your contra is always liquidation account. Step 5 is basically all my payments, right? We said we first pay our liquidation accounts, that liquidation costs, that's step 5.1. Okay, and the liquidation costs were 15,000. So I'm going to pay the 15,000, step 5.1. So I need to credit my trust account. Because I'm paying money out and I'm paying 15,000 Rand for liquidation costs. And I'm going to debit my contra liquidation account. Okay, so this is money physically leaving, entering and leaving. Then step 5.2 would have been to pay any secured creditors, right? But we don't have any held as security for the loan, or they would have said there's a mortgage bond linked to this asset. Okay, so we'll tell you when an asset is secured, then you know if the proceeds from that asset would have needed to first go to that creditor. But there aren't any, so we'll move to step 5.3. Step 5.3 says we need to pay any preferential creditors. Any creditors in terms of the act, right? And anything that's due to employees or to SARS or etc. But there aren't any preferential creditors because we would have told you. We would have used the word preferential. Okay. Or would have given you amounts in terms of the act, and you know it's a preferential creditor. Okay. So we don't have any secured creditors. We don't have any preferential creditors. Step 5.4 is to pay concurrent creditors. Any remaining creditors that haven't been paid. And our concurrent creditor here would be the loan. Okay? Because this loan here was neither secured nor was it preferential, so it's concurrent. So this is the step 5.4 creditor. So we need to pay that guy. You guys happy? Okay? So we would credit our trust account with 620. Oh, sorry, I didn't put this amount here. Okay. So step 5.4 is I would have credited this trust account with 620 and debit liquidation account. The journal would have been the same if I had a secured or preferential creditor. Okay, so now remember, before you do step 6, what do I need to check for if I have any? Before I work out my surplus or deficit, there's one thing you need to check for before you calculate it. If I have any preference dividends, but they said we do not have. So we can go ahead and work it out. Because we would have had to accrue for it and pay for it, then calculate the surplus or deficit. Okay, so now I know that I've accounted for everything. SFP stuff taken here, proceeds received, and all the costs paid, creditors paid. Now I need to work out my surplus or my deficit. Okay, so I just want to show you how everything entered into the T account. So obviously, you know, journals are used to set up your T accounts. So for this journal, I debited my liquidation account with 600,000 for the PPE and the inventory. Okay, so that debit there is those two balances over there, the PPE and the inventory. Okay, I'm not interested in this journal here because remember, you only need the liquidation, the trust, and the share capital accounts. Here, with step 2, I debited my liquidation with 220. So if you go to your liquidation account, you'll see there's the 220 for the accumulated loss. Okay, it was that journal there. And then I credited for the transfer of the loan, I credited my liquidation account with 620. So if you go to your liquidation account, you'll see there's the 620. And likewise, when I received money for the sale of assets, I credited my liquidation account. So there's the credit of 840. And I debited my trust account with 840. So if you go to your trust account, you'll see there's the 840. Okay. I also debited my liquidation with 15. So if you go to your liquidation account, you'll see there's 15,000. Your trust account was credited with 15. If you go to your trust account, there's the credit of 15. And lastly, you debited and credited your liquidation and trust account with 620. So the debit is over there, and the trust account was credited with 620. So there's the credit. Okay, so you transfer all your journals to your T accounts. Okay, and we're only interested in liquidation and trust accounts. Okay, and obviously share capital. Okay, so I would highlight them like this and transfer them over. Okay, everything is in the T accounts now. Now I need to work out what my surplus is. So if you add the credit side, it gives you 1460, and if you add the debit side, it gives you 1455. Okay, so obviously the right hand side is the bigger side, so which means my balancing figure of 5,000 is going to go there. So which means I have a surplus. Because I said the surplus is on the debit side, and the deficit, if the balancing figure was on the credit side, it would have been a deficit. What I first do is I carry the surplus down. So I carry it down, 5,000, balance, carry down. That's carried over. So I first carry it down, and now I need to allocate it to the respective shareholders. That is step 6. Okay. The rule with the surplus is that it goes only to ordinary shareholders. Okay. So I don't even have to consider my preference shareholders. The full 5,000 is going to go to ordinary shareholders. And how do I do that? So it's currently sitting here. So to distribute it to ordinary shareholders, I'm going to debit my liquidation account. Ordinary share capital is my contra. And I'm going to transfer it to the ordinary shareholder, 5,000, which came from my liquidation account, which is the contra surplus. Okay, so can you see that I'm increasing the amount of money that I owe the ordinary shareholder. If it was a deficit, I would have decreased it on the other side. Okay, so the first thing you do is you calculate what's the balancing figure. It's 5. Then you first carry it over. Okay, so don't first allocate it. First carry it down. So you debit your liquidation account and you transfer it to ordinary share capital. So this was step 6. Okay. Because if you didn't carry it over, your journal would be incorrect. If you just went credit liquidation account. Okay, so the journal for that, for step 5, I've debited my liquidation account. After I've carried it down, I debit my liquidation account and I credited my ordinary share capital. So the journal for that would have been debit liquidation account with 5,000 and credit ordinary share capital because I'm increasing the amount of money that I owe them. And I've already processed it in the T account, so I'm just going to highlight it there, and let's make this green. Okay, so now I've done step 6, where I've allocated the surplus. So now I want to do step 7, where I pay whatever's left in my trust account. I need to pay my ordinary and preference shareholders. How much money do I have left in my trust account? If you add the 840, the receipt, less what you've paid for your liquidation costs, which was step 5.1, and the loan was step 5.4. Obviously, if we had preferential and secured, it would have also been here. Okay, so how much do I have left in my account? Physical money, I have 205,000 left. Okay, so that, less that, gave me 205,000 left in my account, which will be exactly equal to ordinary plus preference balance. Okay, so 105 and 100 will add up to 205. Like I said, whatever you have in your trust account will be exactly equal to your balances in your ordinary and preference shareholders account. Because as we saw before, this year is everything from your SFP is here besides share capital, and this is everything in your trust account. So obviously the excess is a surplus or a deficit, which you adjusting for in the share capital account. So it must equal each other once you've paid it. Okay, so I owe ordinary shareholders 105, I owe preference shareholders 100,000. Let's pay them. So I'm going to reduce my ordinary share balance with 105. And it's going to come from the trust account. And I'm going to reduce preference shareholders with 100,000. It's going to come from the trust account. Okay. And this is 105. I'm making another payment to ordinary share capital and preference share capital 100,000. Okay. So can you guys see that? There's which is step 7. I've now paid 105,000 to ordinary shareholders and 100,000 is leaving my bank account to pay preference shareholders. You guys see that? So now I will have a 0 balance in my trust account and I will have an exact 0 balance in my ordinary share and my preference share accounts. Okay, because the balance is now 0. What was the journal for that? So obviously I paid my trust, money left my trust account to pay ordinary and preference shareholders. So credit trust account with 205,000. Okay, so that was that journal over there. Credit trust account with 205,000. Money actually left my trust account. And then we said we're going to debit ordinary share capital. We're reducing what we owe them by 105. And we're reducing what we owe preference shareholders by 100,000. Okay. If your trust account funds are not equal to the balances, then you did something wrong. It has to clear out. Everything has to clear out, especially after you've allocated the surplus or the deficit. Okay. But does it make sense that, can you guys see that, can you see why it works out? Okay. Okay. Right. So it's not always the case that preference and ordinary shareholders get funds, because sometimes there will be, once you've worked out the proceeds less your liabilities, sometimes there's only just, there's not even enough money to pay your concurrent creditors and you have to pay them pro rata. So if you've paid your liquidation costs, you've paid your secured creditor, step 5.2, you've paid your preferential creditor, step 5.3, and now you want to pay your concurrent, you might not have enough money to pay all of them, so you pay them pro rata. Which means if you don't have enough money to pay them, you're not going to have money for your shareholders, because they get the last balance. So that's just something to look out for, but we'll look at questions for that in future. Fairly simple? Yeah? Just go through the steps. Okay. I want you guys to ace this now, because it's like easy, very easy marks. Okay. So tomorrow we're going to do 6.2. So if you can have a look at that before class. Thank you.